Turn me up. All right. Hey there, boo-boo. We gotta get the pips from the picnic basket. Good morning, everybody. How you doing? Boy, you look good. What are you doing? Working out? Is that a new haircut? Have you lost weight? Have you grown taller? Holy smokes. Welcome to Forex.Today, the YouTube community of more than 21,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance because trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Huh? It's the economy. Oh, look how dirty that is. I don't know if I can even clean it. That's all. Gross. And you're like, what is all that gross stuff in your coffee? I drink ghee for breakfast. That's butter. Clarified butter. So anyways, that's cool. So what do you want to do today? Technical analysis? Sure. Fundamental analysis? Yeah. You want to talk about the Bank of England or the Fed? The Fed's talking about maybe cutting. Probably cutting. Bank of England is already cut. Bank of Canada is already cut. The European Central Bank is already cut. China's cutting. Huh? Yeah. Yeah, boy. Now, it's interesting. Cutting for exactly the opposite reasons, right? But yeah, anyways. All right. So I guess we'll start on the fundies. What do you stink? Smell like a plan? Yeah. Okay. So let me tell you how I'm going to simplify your life. Okay. First of all, you need an ECN. I recommend Trader's Way. I have been for 10 years. See, they recommend me, I recommend them. How nice. The reason I like, well, there are a few. I've worked with them for 10 years. They seem to be very nice people. Real people. They're actually real people, and they're nice. We talk about our kids, They're real people. They use a business model called an ECN. That's a fancy way of saying they don't trade against you. That's not how they work. That's not how they make their money. They simply want to provide you an honest service. I like that a lot. Go check them out. Do your own due diligence. Okay? Then I started Investor Bootcamp 20-something years ago, and it offers training and coaching. Pretty easy to understand. There's 100 hours of training videos, and we have a couple of live groups to give you hands-on training and give you an opportunity to ask questions. So like Angel asked a question yesterday in our live group, and I probably gave him a half an hour answer. Or wait, no, that was at the live stream. Anyways, this is, me making myself available and others making themselves available to help you succeed. Cool. Really nice. Okay. Then to help you even further, QuantBox was invented to help you do your fundamental research and analysis so you could create a bias based on logic and intelligence and facts like institutional positioning. Like, what the central bank has told us. You don't guess. You know. Okay? QuantBox subscribers knew the Bank of England was going to cut today. Why? The Bank of England already told us. And yet, media freaked out like it was unexpected. Oh my God, 5-4. Oh, they cut. What does it mean? Dude, we had it plotted on a graph. Okay. Right? Very, very cool. So now you have a way to automate your fundamentals. And the upside to this is you would organize your trading and investing based on things like interest rate differential, employment, inflation, GDP, technical trends, seasonality, retail positioning, institutional positioning, and then you add them all up, and then you do comparative analysis, and then you organize as things you're interested in buying, things you're neutral on, and things you want to sell. It's just, and then you start here in the morning, right? And you start your day by looking at the positive, the buying opportunities and the selling opportunities. You ignore everything else. You find things that are out of position. And you're like, oh my God, everything you do now makes logical sense. Oh my goodness, what an amazing change, right? So this helps you with your strategy. And of course, things that are lined up seasonally with technical trends are probably worth more than 30 pips. So if you're a day trader, scalper, and you're like, oh my God, I'm the world's greatest trader. I made 30 pips today. I'm the world's greatest trader. Well, congratulations, but no. QuantBox will tell you like when to let your winners run. Okay? Yeah. Cool. My pound yen trade is now 1,200 pips profit from last week. Yeah. But QuantBox told me all of that. All right. Cool. And then there's one more. This is called a value ladder, by the way. Okay? They're not necessarily stacked like one is 10 times better than the other. No, it's more like flat, if you will. And let me explain that in a second. So TradeRs does all your technical analysis. Watches 7,500 charts. So your trades, let's say, will look like that. So if you want to trade stocks like Tesla, cool, done. Sell high in a falling trend on a 4-hour chart. Cool. Now, it'll also find all the patterns that are reliable. And it's not making a trade recommendation. Don't think of TradeRs as an alert service. I would never belittle and embarrass you like that. See, like, I don't like people that want an alert service. I just don't. Like, you don't want to do the work. You want someone else to do the work. You should quit. Okay? So this is not an alert service. It just does the technical analysis you're supposed to be doing. So sometimes in a downtrend, like let's say this drops down and it gets to the bottom, well, it's going to assume now that we're at the bottom, it's going to go up. So it's going to tell you, and you're going to get a gray arrow up, and it's going to point up. Does that mean buy? No, it means the next part of the pattern is up. You have to be smart enough to know you only sell in downtrends. You only sell at resistance. As long as you know that, TradeRs will just help you focus on the thing that's actually happening now. And you're not just trading euro dollar because you like euro dollar. No. If Tesla's what's moving, Tesla's what's moving. But of course, there's S&P 500. There's, Aussie dollar. How do I make it slide? How come it slides sometimes? Do you have to do that? Yeah, all right. So multiple time frames, multiple patterns. All right, anyways. So TradeRs does a lot. So the value ladder here, what I wanted to get to is I realized that it's not truly a value ladder in the sense that you start with training, and then you get some coaching, and then you add fundamentals, and then you add technicals, and then you've walked the stairway to heaven. I'm like, well, it's actually not like that, is it? I realized it's horizontal. And it dawned on me like, oh my God, this is a Bloomberg terminal for retail traders and investors of all markets, stock market, stock indices, commodities, crypto, Forex, but it's a platform where we can have training videos and performance coaching and live events and live Q&As and community feedback and software for fundamental analysis and software for technical analysis. I'm like, it's holistic. I don't know. You can't remove any of these things in my mind. Oh, Wayne, I only want you to show me the patterns. I don't want to know any fundamentals. I don't want any coaching. I don't want to learn how to trade. Well, then you're thinking about it as an alert service and you've already failed. Forget it. You don't have what it takes. Just quit. I want to be an Olympic athlete. I want to win a gold medal, but I don't like working out. I don't like training. It's hard. I don't like dieting. Well, you know what? You should sit on the couch and watch athletes. You know how difficult it is to be an Olympic athlete? Blood, sweat, and tears, sacrifice, investment, and money. It's hard to be an Olympic athlete. So you're better off watching it on TV. Okay? But what if you do want to compete? What if you want to be competitive in the trading and investing world? This is a pittance. Okay? This is a pittance. Yeah. This is a pittance. It's so amazing what this is going to be. And the cost is going to be less than I used to pay just to have charts. So anyways, so all of this I just showed you, in a few weeks, it's going to be one big thing under TradeRs, and you'll have everything. Imagine that. Everything you need to succeed as a trader and investor. And I am ridiculously excited for us. Cool. All right, so I did QuantBox live for the subscribers just minutes ago. And everyone's like, get out of your yen, get out of your yen. Well, remember, this is my coaching platform. It's live, but this is designed, I mean, look, it's only a it used to be a $30,000 account. Now it's $37,000. But it's designed for me to teach and for you to learn. And some of that is I'm okay with learning from making a mistake. Okay? And one of the things I know many of you are working on is letting your winners run. So when I do something like this is a very logical trade. Okay? And I've let it run. There. That's how you do it. Okay, so there's one win there, not the pips, but the ability of how do you get into the trade and hold it. Well, you saw me do it. Okay, then I showed you and even took example trades of how to get in and add to it. And those did really well. I'm not in them anymore, so whatever. It's all history now. But anyways, I showed you how to do it. We talked about it. I set it up, and I did all this, and we had plan A and plan B, and I talked about the moving averages, and I mean, we set. I mean, you had 1, 2, 3, almost 4 days, right? I'm sideways. So anyway, so all that's happened. Cool. Now, should I get out here? Well, I see the logic, okay? Because you would say, well, in the training course, when the central pivot is the high, the S2 is the low. So yes, you are, and again, before this green arrow or green candle, at the QuantBox live presentation at QuantBox, everyone's like, you need to get out, you need to get out, you need to get out. And you're absolutely right. If this is a swing. That is the 100% correct decision for a swing methodology, right? So cool. Right on. that would be it, right? That would be it. Cool. And that's a lot of pips, right? Sell it at 199. It dropped to 191, so 800 pips this week. Yeah, nice trade. So should you take your 800 pips and run? Well, that is the decision. That is the correct decision. Well, the true answer is it depends. What if I'm a position trader? Okay. I might be targeting 180. Maybe. I don't know if it's true. I don't know who's right. Okay. Because if you are now a bull and there's profit taking here, okay, great. That might be all the bears leaving. And then I'm making a mistake if I leave it. Well, that would be a learning experience for you. That's the whole point of this account. Okay. The 200 EMA is the neutral zone. It's a target, not an entry. That's from my book. So it doesn't tell you up or down. It's not support, it's neutral. That's the fair market value. The fair market value. Now, these are all my terminology. Remember, I'm self-taught. There were no gurus. There were no books. There was no YouTube. So I had to come up with all these terms. And that, to me, the reason it's here, it's the fair market value. It's not support. Okay? This is support. This is where you're supposed to buy the pound yen. Okay. All right. Cool. So, could this happen? Yes. What would make that determination? Well, usually that'd be the central bank or seasonality. Do we have that going on right now? I would argue no. Okay. Could we have a version of this? Yes. Some profit taking, some re-entry, somewhere between here and here. Right? Okay, yeah. Okay. Or an out of position trade. Could that happen? Yeah. Okay. So now we got three scenarios. There's a high probability one of those is going to happen. With that being said, Michigan. Who would call me from Michigan? Probably a board member. Dude, I freaked out. I freaked out. And on my endowment people. And I'm like, I want everything. So people are probably freaking out. Everything, I want everything. I'm doing a full, complete audit of every detail. I want every document. I want every statement. I want to know who set this up. I want to know who is holding it. Who's the decision maker? How is it constructed? How is it performing? I want everything. I want every penny, every document, every statement, every everything. I want everything for everything. People are like, oh God, we made a mistake. We put this guy on our board and he's making us work. So anyways, that's probably what's going on there. All right. Anywho. That's the right attitude though, right? You want to know everything about everything. All right. All right. So anyways, we got three scenarios. Your job is to, first of all, know the three scenarios. But on the flip side, be ready, willing, and able to recognize all three. And then adjust as needed. So for everybody that is getting out, that makes a ton of sense. So this speech isn't to say, oh, no, you should stay short. No. You're recognizing one of the plans, but probably more on the shorter term. Because that's like saying you sold here and got out here. So that trade is done. Okay? Well, what if this falls 5,000 pips? Okay? Then this little move this week from here to here is a pittance. Okay? Okay? You should know what I'm talking about? So that's probably what's going to happen next week. Wait, is it Thursday? Oh, yeah, it's Thursday. So we're doing the swing trading group, huh? Swing traders. Swing traders. We're going to meet at 4. We're going to plan next week. Okay? And this 800 pip drop is one of the things we planned last week. Yup. Mm-hmm. Yeah. Oh, yeah. I even put trades on it. Yeah. I don't think my limit was 800 pips, though. Well, there you go. So, very neat. Neato. My template is off, I can tell. There we go. Oh, I see why I did that. Interesting. Whatever. Cool. Yes, every single swing trade meeting and every single day trading meeting and every single Quant Box live meeting is recorded and archived for your viewing pleasure. Yeah, Eskimo, right? Not only do you need to learn how to be a fisherman, you need to know how to be the fish. Is that right? McKenna's in. D-Mac. McKenna. Very cool. I was just going through like it must have been at least 100, probably closer to 200 tartans of mix and max of all kinds. Cool. So, for example, McKenna, I just got a message saying that in QuantBox Live, there is a new recording from the live strategy webinar room at QuantBox. And it says it's now available in the course. Okay, so you're even alerted that I've started a live stream, and then you're alerted when the recording is available. Beautiful, right? I know. Everything is integrated. We really have a really nice system. All right, so anyways, there's that one, whatever. I mean, dude, you sold the ends, really? Okay. So look, we just hit my line in the sand. Let me go back. Okay, these lines I drew, I don't know how long ago. A long time ago, bro. Okay, a long time ago. Beep, 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 beep. Okay, so now I zoom in, and we hit it and stopped. Oh, you're welcome. Okay, only went back years to come up with that price. Cool, right on. Nice to know, yo. Okay, so we hit the monthly S2. Okay, not 161, but 160.97. Plus you have to cover the spread so you can see everybody knew this number. Everybody knew this number. They had to drop below, hit the target, and stop. Everybody, 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 everybody. Yeah. Cool, right? So if we were just doing blind price action on a naked chart, I would do this. In fact, do you guys want to get naked? Yeah, let's get naked. Let's get nay-nay. You know you want to. You've been thinking about it. I know. How shall we go nay-nay? We can go nay-nay on the ribbons. Yeah. All right. I think the ribbons are a version of naked trading. Okay. In the sense that you're riding the ribbons, then you're neutral, then you're riding the ribbons, right? Or for a more complete ribbon, we can go to rainbow and you'll see it's more. Okay. I like this because to me, I see the trend. I think clearly there was a drop below. Okay, back to the ribbons, sell it. Down, back to the ribbons, sell it. Down, back to the ribbons. And the further into the ribbons, the bigger the pullback and the cooler it gets, right? So we're just riding the red and yellow zone. That's smoking hot, right? Hot to go, HOTTOGO. And then, holy smokes, look at it cool off. Should I temper my enthusiasm? Yeah, maybe. Okay. Oh, maybe it's going to break down. Oh, no, maybe it's going to. Oh, nope. Okay. So that kind of stuff. Like, is it red hot? Yeah, it's still pretty red hot, although it cooled off a little bit here. So I don't know if this helps you. I don't know if that helps you. Is there another one that I could do, like the simple one, money management, trend lines sometimes are really nice. So you don't know how to draw trend lines? We'll have the machine do it. Okay, there's 3 trends going on here. The big trend, and notice we've breached the big trend. Yeah, let's go to an hourly. Okay, we've breached the big trend. And we have the shorter term trends down. Cool. So to go nay, right, that's pretty good. There's just some moving averages. I would look at, I'd connect this low with that low. And you're like, Wayne, I can't see it. Zoom in. All right. Gee whiz. Get so upset. All right. And let me give it a click. Okay. So I connected that with that. So one methodology you could do here is up into this zone, and then, is this a bullish trend or a bearish trend? I'll let you think about that. Okay. Now you might say, well, Wayne, what if it goes up? See, I don't think that way at all. Now we know it always can go up. It always can go down. Okay. Well, that's no way to be a trader or an investor, right? The world is dangerous. That means you should never go outside. Well, that's a terrible way to live. Okay. All right. Right, like I was watching a YouTube video on cruises. I don't know why. I don't know anything about cruises. I've been on one cruise in my entire life. But they're like, women are very concerned about being raped on a cruise. And I'm like, oh, yeah, man, there must be tons of predators out there. Or you just go out there and everyone's drinking and, and bad stuff happens, right? And I'm like, yeah, dude, if I was a woman, I would be like red alert on everything, right? And then apparently, according to the FBI, who investigates these crimes, they're like, you're 10 times more likely to be raped on land than on a cruise. Like, kind of like you're 10 times more likely to die driving to the airport than dying on an airplane, right? So it just, these stats. So you can't be worried, but you should be aware. Okay? So yes, you're vulnerable to what if this goes up and goes higher? Okay, okay, you need to be aware of that. But if this is a downtrend, it's a downtrend, and that is that. Okay? Okay? It's just that. Okay? Like, that is down. Yes, it might go up, but that's not likely. So you plan for probability, right? Now, if you go to a 4H, and I zoom in again, you'll see what that truly is you're kicking it off the 4-hour 21. That's not a bad trade at all. Could it go as high as the 55? Yeah. But let's leave that for a different plan. So let's mark that. I guess I'll use an arrow here. Boop, boop, boop. Okay? And then we'll place an arrow here to remind us. Boop, boop, boop. Okay? Then we'll go back to the hourly. What do we have here? Plan A, plan B. Oh, look at that. Okay. So what about the shorter time frame? How do we play that? Somewhere between these two. Okay? So now if you're going to do it with that type of methodology, let's kill that. Let's get less things. Let's make it easier. I'm always trying to make it easier to make the decision. I admit I never know what's going to happen, but it's a decision-making process that makes things easier for you to make decisions, even if you don't have all the information. You need some fluidity here, but in the fog of war, it's nice to have some fog lights, So now on 2 time frames, hourly and 4-hour, we have some plans. Now you can combine these and say this one and this one are the same. I don't mind that. Okay? But now you know the key prices. Well, what about on the daily? Your next opportunity on the daily... Wait, I'm missing a 5, aren't I? How funny is that? Where'd my 5 go? Okay. And I'm zoomed in as much as I can. All right. Okay. You see this one where I said you can combine? Oh, thank you, Jim. See this one where you see you can combine? You're front running the daily 5. Does that matter? Well, I know you don't spend much time on the daily. I know you don't. Shh. Don't argue with me. You know I'm right. Okay. Euro yen. Okay. This is a bearish engulfing candle. Something unique changed. So, okay, this should have some meaning. The next thing is what is important after a massive collapse. Now, you know there's a pivot point in here somewhere, so you know it's not just a bearish engulfing, but you should respond to a giant bearish engulfing, right? Okay, great. The other thing is these longer-term moving averages do mean something, but this 2155 I've taught you is very important. So when do you buy again if you think this is going to be bullish? Well, I wrote a whole book on that one topic, and it's when the 5-8 turns bullish again. So when this moving average crosses up and this one crosses up, and your trade would be something like this. So I'm not going to tell you that I knew for sure this was going to drop. There were many fair arguments to say when this turns bullish, when this turns bearish. Okay, great. And you could easily have been a bull, but now we know bear was correct. Okay, it's really when you've decided that if you were a bull, you're wrong. That's what matters. Okay? It's not that you're always right or wrong. You're the world's greatest trader. No. Okay? It's when you realize that the bullishness is never coming back. That decision, like here, matters, doesn't it? The break lower than the daily 21, the break a new lower low. Because, like, for example, do we have pullbacks in uptrends all the time? Okay. Abdul, that's an OOP. It's in the training course. Probably day trading. Okay. So you can have pullbacks. But you know what I don't like as a bull? Lower highs with lower lows. So like really right in there, all hope is lost. Capitulate. Okay. Abdul, you should join either the day trading group or the swing trading group. Now the day trading group gets the swing trading group and the day trading group combined. But if you're like confused and stuff, oh, that's easy. Fix that. Not a problem. All right. So we're in this point now where you should be riding the 5. Up to the 5, down. Up to the 5, down. So what are we planning today? Up to the 5, down. So now I've just done daily. Okay. 1 day. I've done 4H. I've done 1H. We've looked at it in multiple time frames. Which one's right? They're all right. Okay. They're all right. The thing is, many people only look at, this and maybe like 15M. Okay. That's probably 90% of all trading for retail traders. And what they miss is, oh, it's going to move 1,000 pips. Okay. And you're happy because you made 55 today. Okay. But you gave up 945 pips opportunity. Okay. You should be stacking them and packing them. So, like, there's the key moment. This is a key moment. And this is a key moment. And the rest is, up to the 5 EMA, up to the 5 EMA. Look at this, 5 EMA, 5 EMA, 5 EMA, 5 EMA, 5 EMA. It pierced it, came right back. Notice where the real body closed, Up through the 5 EMA, and look where the real body closed. Happens over and over and over and over and over again, right? Can you see the potential that if you know how to trade the 5 EMA on the high time frame, it tells you what is likely to happen all day? I want you to put this into context. You show up to trade and you already have a clear idea what's going to happen today. Would that be helpful to your trading? Okay. I teach a concept in the day trading group called trading inside the wicks. Is there an H in there? Wicks? That doesn't look right. Is that right? Is there an H in the wicks? Okay. Inside the wicks. So you already know direction. Okay. So now you're inside the candle. Okay. So at some point, this is the lowest low. This is the highest high. This is the open. This is the close. Okay. So you know two things. Okay. It opened bullishly. It dropped like a ton of bricks, and it closed bearishly. So there's a very high probability of the next one being down. Okay? So once again, once it gets going to the downside, okay, you have these wicks. Okay? So when you're here, up, there's the wick. So you go from basically like this lowest low to this highest high. Okay? Oh, yeah, Fibonacci. Okay? This low, okay? And then it pulls back. So, like, you can see we never get a higher high. Ever. So you already know. So, like, for example, from this low yesterday to this high yesterday, you're going to sell. Do you understand that? What's the worst case scenario? Yeah, today we have a giant green candle that goes all the way up here. Is that likely to happen without a fundamental change or mass exodus or something? Like, not likely. It could happen, but is it likely? Is it probable? What's the probability? The probability is whatever made this drop remains. Okay. All right. Fine. Cool. So we've made a determination somewhere between here and here is a sell. What's been a good determinant of that money, of that price, of where to sell? Well, it's not this price. Why not? Does anybody know? Because that's today's price. It's going to be tomorrow's price. So we had a low here. Oops. Okay. We had a low here and slowly worked its way up, and eventually it worked. The thing is, the 5 EMA would have been about here at the time. So, you have to fire in front a little bit. So now you can use a tool to try to maybe predict where that is. Now, we do have a tool, and people have it as members of it, Investor Bootcamp, and it's called the Zero Lag Moving Average. Now, I don't typically use it for 5 EMA, but let's see if it helps. I don't know. Maybe it does. Fire brick, and we'll make it super fat. All right, let's see. Hang on, I messed it up, didn't I? Oh boy. Input. There we go. We got to put it on a fiver. All right. There we go. So it is saying it needs to come back a little bit. And it should adjust by tomorrow. So we might not be selling this today. We might be selling it on Friday. But what we can guess is it's somewhere between, where we are and this price. not likely this price. Okay. So what does that get you? Probably somewhere around here. Yeah, I already did that for you. Now you can say, well, that's hard to trade on a daily. Okay, because it's not very accurate. Okay. So you delete that now. And we go back to our pink arrows. We're right back to where we were. Maybe it rolls over. Yeah. All right, let's add another tool. Indicator, custom, biased pivots. This is an invention of mine. Once again, you get this from Investor Bootcamp. Okay. All right. And you're a bear and you want daily pivots. Okay. Right. And midpoint's true. Great. There we go. Wait, what? See how genius all of this is? Huh? It's genius, isn't it? Wait. Wayne, using moving averages, you calculated the central pivot point and the M3 of the daily pivots? Uh-huh. Well, wait. Are they using the same math as the daily pivots? No. But they end up representing the same sell zone as the moving average, right? Yep. So daily pivots, moving averages, no relationship, but yet they end up telling you to do the same thing for virtually the same reason. Is that right? Yep. And that they represent dynamic resistance on multiple time frames? Uh-huh. Well, that's amazing. I know, right? G'day, Joseph. How are ya? How's your mum? Richard's made 2,000 pips in 10 days on the Kiwi yen and the pound yen. You know what you just told me? You never reloaded. You never reloaded. So I want to congratulate you, Richard, on 2,000 pips. But if I was your boss, I said, Spencer, why isn't it 5,000 pips? If I was your client and I knew about the markets, I'm like, Spencer, why is it not 10,000 pips? Clients are always have the wrong expectations. But like, that tells me you got one trade on each. You sat there for 10 days and you never reloaded. So there's another up. You need to up your game even more, right? Yeah. Okay. It's sort of like an army that starts to win a battle and the enemy turns and runs. So you stop shooting. No. Keep firing. That's how you win wars. It's an ugly, brutal analogy, but like, you're winning, dude. Keep firing. You have the upper hand. Keep firing. Okay. So anyways, brutal analogy, but maybe you might remember it because it's so horrible. No, there are plenty. See, going back to what I was saying, even on a daily chart, every single one of these candles has an up. Up, right? Down, down, up, sell. Okay? Down, up, sell. Okay, even here, there's an up from here. This is what I mean by inside the candles. If you see from here to here, sell it. Okay, from here to here to here, there's a sell. From here to here, there's a sell. Okay, so far there was a here to here and a sell, but it's already capitulated and back up because we already know this is a logical target. See, the thing is, this is expected. It's so obvious. It's like asking a 7-year-old to do their ABCs. Like, this is so ridiculously obvious. And now it's up this way, of course. And everybody at QuantBox an hour and a half ago were like, you need to get out, you need to get out. I'm like, yeah, I totally agree. That totally makes sense. All right, so like everybody knew. Okay, but the thing is, are you still a bear? Or has enough changed that you are no longer a bear? I don't know. But right now, that's where the 5 EMA is. But the other opportunities are more like this. And I analyzed it on multiple time frames and all that kind of stuff. But nothing was bullish. And I'm trying to get rid of the idea of, well, what if it turns bullish? What if it reverses? Well, one problem would be is you ignored all of this, okay? And then now you wanted to sell down here. That just means you don't know what you're doing. Okay? We know that's a weekly S2. I mean, dude. Like, it's like, if you don't know that, because you're like, Wayne, that's not on the chart. Well, you should know. If you don't know that, that's one of the things that's impeding your success, your destiny. You're not fulfilling your destiny, and that should be like, well, why don't you know that and everybody else does? Well, if you're trying to be competitive, you're like, dude, that's a problem. Yeah, it's not a slap in the face. You should want to know your weaknesses. Okay? Okay? So like for Richard Spencer, you probably like this idea here. He made 2,000 pips and I did give him a bitch slap. You're like, dude, 2,000 pips is a lot. It is. Yeah, congratulations. But the next level of competitiveness is, you sold here and it dropped. Great. But missed this one and missed this one and missed this one. And, like, there's more. There's more, right? You can go back in and frack that well. There's more oil down there. Okay? Get in there, Spencer. Huh? Frack those pips. It's not about drilling. Can you imagine you're out there in Texas somewhere in the Permian Basin? Okay, what's your job? To drill or to suck oil out of the ground? Right, Richard? Yeah. Yeah, and Richard, that's the attitude. Like, go back and simulate. Okay? So at FX Bootcamp, we have this new performance coaching program. And it's all, well, I shouldn't say all, but heavily focused on simulation. So like what you're talking, so if you know how to do that, go ahead and do it. But it's like, okay, you made 2,000 pips. Great. Awesome. I mean, honestly, congratulations. That was a good trade. And hanging on to trade, especially when you're not using it, that's great. I mean, you got a real experience out of that. Now go back and do it again. Do it through simulation. Pull it back up. And get yourself in a situation, like don't overdo it. Like now that you know it's going to drop, now it's easy to sell. Try not to do that. But at what point, like I highlighted, like this is a red flag. This is an O for show. Like, dude, it is a downtrend. So then you would kind of like, how would you know that on, you go back and live it on a 1 hour chart or a 4 hour chart. And then when you're in here, teach yourself how to be more aggressive. When you're right, be very, very right. Okay? So if you were going to like tie this into like degenerate gambling, so if you're a card player, the secret is to know when to bet. You have to know how to win. Okay? It's not necessarily the card play. It's knowing when to go for the kill. Okay? And knowing when to fold 2 jacks. You got a pair of jacks. Fold it. Okay? That's a hard thing to do. But you need to know. But the other thing is, when you know the probability of a win there, you need to win big. You need your stack to grow and other stacks to get smaller. And the more that happens, the more you can force them to make mediocre bets. Okay? I don't know. So again, I don't know if that's a good analogy, but the idea is you need to know when to win. Okay? And you need to win big when you caught a trend. Okay? You must win big, because remember, I showed you, what was it, 2 months ago, 3 months ago? I had 80% losses. Do you guys remember that one? %80 losses. Does anybody remember this? I had 80% losses. Did I lose money, make money, or break even? Yeah, which tells me I know how to lose and I know how to win. I made money. Now, someone told me the other day that their guy over years has an 80% win rate, and I laughed in their face. Yeah. Oh, so their guy doesn't know how to take a loss. And somehow they have pride attached to this statistic of their winners. Dude, that is a death trap. Remember, I haven't read anyone else's book, but I doubt anybody said this in their trading book. In my trading book, I said, take pride in your losses. And if I was trying to raise money from a wealthy client and it was time to go over the track record, I would start with all my losses. I would start with my worst day. I would start with my worst trade. I would show them all my dirty underwear first. Yeah. Yeah. 80% winners? Bull shite. It just says, well, you never got out of your losers when you should have. So your drawdowns are nasty. Nasty drawdowns. And whatever, bro. Okay? Like, let me make an example. Let's say, so I have 30 or 40,000 in this account. Okay, great. Let's say I take 4 mini lot trades representing 40,000. Okay, cool. And what if I did nothing for 3 years? I didn't add, I didn't exit, I just held them. I have 100% winners. Now, what if they drop? Well, I don't think they're going to drop enough for me to blow up my account, because basically I have no leverage, right? So I don't think I would blow up my account. All right. And I never got out for a loss, so I have no losers. Oh, they might not be making any money. Oh, but I've never recorded a loss. So what if I sit it on for 4 years? I don't even look at it. 4 years from now, I come up and I've made 300% return on investment. Am I a genius? Or am I lucky? So, like, you got to be careful with these things. Now, what if I took, let's say instead I doubled my money, not tripled or quadrupled. Let's say 4 years later, I doubled my money. You might say, wow, dude, this is great. This guy doubled the money in 4 years. Okay, great. But what if along the way I took a 50% drawdown? Now, I never took a loss. I never got out. Okay, we call that the pain to gain ratio. Is it okay if I was trading your money to be down 50% and not do anything about it? Are you cool with that? What if it was 80%? What if it was 40%? You see what I mean? Like, oh, but he's never taken a loss. Yeah. Well, what if the loss was catastrophic failure? Well, the nuclear power plant hasn't blown up yet. Well, what if it did? Wouldn't you say, well, the loss, like, if that failed, it would be so bad that we need to focus everything on absolute prevention of that even becoming a possible reality. Even though it's very unlikely, you need safeguard after safeguard after safeguard, because it's so bad if it happened that you would never want it to even be remotely possible. But for some guy like 80% winners, I'm like, here's a guy running Chernobyl. Well, it hasn't blown up yet. Meanwhile, everybody at the controls are drunk on vodka, and all the people that build it were drunk on vodka. Johannesburg has a Russian-made nuclear power plant in the middle of their city. It doesn't work. Could be the same vodka. So it's just like, no, loosey-goosey. I want you to show me lots of losers and that you made money, because it shows me there's massive risk control. Massive. I want insane levels of risk control. So catastrophic failure is completely as close to reality of absolute zero as possible. The losses are beautiful. I rarely take losses. You're fired. Get the hell out. Because when he does lose, it's going to be, well, you know what? The nuclear power plant blew up. Millions of people are dead, and everybody else has, radioactive poisoning that's going to last 300,000 years. Well, nobody wants that. Okay, so it's really an attitude thing. So I've always had that, disrespect for the world's greatest traders. I'm so good. Yeah, right? Oh, yeah, you're so good. Here's what I would say. Wow, those results are amazing. Your track record of winners is really impressive. But right now, for us at our fund, it's not the right time. We already have enough exposure to the foreign exchange market or whatever. And even though we would like to, it's not the right time. So let's keep in touch. Why don't you send us your results next year? And maybe we'll regroup then, which is a FU statement. Take a hike, bro. Adios, muchacho. Okay? Now imagine I sit down, I'm like, let me show you my dirty underwear. Meaning, let's talk about my worst trade. Let's talk about my worst trading month. Okay? So, for example, my worst trading month this year is 2.7% down. Okay. What would a professional institutional investor do? How do you analyze that? Is that good, bad, or ugly? Is it acceptable or unacceptable? Well, first of all, an institutional investor has made, let's say, 100 investments. They invested in me. They invested in David Pegler. They've invested in Richard Spencer and a whole bunch of other people. And they say, oh, Wayne was down negative 2.7 in April of 24. Okay. Is that good, bad, or ugly? How do you figure that out? Okay. And what if Richard, so that we'll do this, Wayne McDonald, okay, Richard Spencer, RS, was at 0 that month. And David Pegler, okay, was at +2. Okay. Now what? What kind of questioning would an institutional investor have in this situation? Now, they're in my office right now, and I'm doing this presentation. But they also, in their pocket, know what Richard did and what David Pegler did, and they know that these are comparative. We're all Forex traders, let's say. Or I'm actually talking about the stock market. So we're all long-short equity type strategies. Well, you could look at measures like Sharpe ratio, beta, absolute return, okay, Sortino ratio, okay. But, okay, let's talk about beta. Okay, let's talk about beta. The S&P 500, which is a benchmark for this type of fund, was negative 4%. My fund lost 2.7. Okay, my beta is less than 1. That is good. Cha-ching. Okay, Richard's even better. Cha-ching, cha-ching. And David Pegler made money that month. Cha-ching, cha-ching, cha-ching. Okay, so my negative 2.7 is less than negative 4. So that's quite good. So that's impressive. I have a low beta. Now, then they would say, well, okay, that's acceptable. The market fell for everybody. And I somehow either have a portfolio constructed to handle it, or I did something, my behavior adjusted to mitigate it. So what did Richard Spencer do? Well, we don't know. So it'd be like, okay, what did Richard do? Was it a construction situation? Did Richard adjust? Or, because you're trying to figure out, is it luck? Is it random? And then they're like, but David Pegler made 2 plus 2 in a negative 4 month. Well, what the hell is going on there? And they might find through a risk performance analysis that David is using quite a bit of leverage. So they dig deeper again because they're institutional investors, and this is the due diligence. And they find David was down negative 5 at some point and then turned it into a +2, throwing down some Hail Marys with some leverage behind it to dig him out of the hole. But because he was in the hole, maybe he had some shitty strategies and tactics. And then using even shittier, sorry, David, shittier strategies and tactics, he leveraged up and took even more risk to drive himself out of the hole and then ended even higher. And they're like, dude, You have the best performance by far, but you did it from degenerate gambling with leverage. You could have been a minus 15 for the month. Yeah, but David, like, right, you've seen other groups do it, right? So I'm not really saying David would do it, but David's a professional, and he knows, like, the biggest winner isn't the better trader. Almost always, it's the worst trader. So you're like, dude, okay, the market fell. How the hell did you make money? Degenerate gambling. So, but if things had gone the other way, can you imagine a minus 14 for David? But somehow he flipped it and got a plus 2. Is it worth the risk to go? No, it's not. It's not. So the biggest winner is fired. Okay? So then we're like, okay, Richard Spencer versus Wayne McDonald. Which one's better? Well, again, now you'd want to look at all these different measures, analytical measures, and it comes down to what you want. So how did Richard get to 0? Well, maybe his strategy is so conservative that it never makes any real money. So by the end of the year, his best year is plus 5, and his worst year is negative 5. But on the long run, he makes nothing. So in horrible months, though, he'll outperform. And in normal months, he'll underperform. But that might be the safest and the worst of the worst. Are you trying to get minus 30? Or are you trying to prevent minus 30 ever happening for when the stock markets collapse? And for that, you're willing to say you'll never get a plus 30? Well, I'm making that decision. My portfolio will never have a plus 30 year, but I'll also never have a negative 30. So Richard might set it up where he'll never have a plus 30, he'll have a negative 30, but what does it actually end up? So he's actually market neutral. He'll never win, but he'll never lose. Is that what you want? Well, in some situations, in some market conditions, that might be very attractive. But you're like, no. I want to make some money. So let me go back. My worst month, and I've only had one down month. Okay? Let's do it this way. Let's do it this way. In my fund, we'll never have plus 30, but let's say plus 20 is good. And will I have a negative 20? No, not likely. What would be safe to put here? It would have to fall a lot. But let's say total return is, could I even do a negative 20? Yeah, I could do a negative 20 if we had like a total collapse. But let's say, except for like black swan events, let's say my worst is negative 10. Now the stock market would have to be down a lot. Okay. So I have a little more upside and a lot less downside. Now to give it up, I'll never have a plus 30. But I'll never have a negative 30 unless there's, like the stock market's down 75%. Then we'd have to talk about that, but that's not realistic, right? So how is this attractive? Maybe. But you're like, I don't want to give this up. Well, a lot of people will give this up to prevent this. But then if you average that out, you're like, but then, so then I throw in one other thing. Of this plus 20, let's say on average, 50% of this is cash. And the reason the negative 10 is there is even if the stock market dropped negative 20, I get 10% cash. So you got to like offset that. So how do I get the, right? So imagine if the stock market fell, I still paid you 10% cash. So what I'm actually pricing in here is if the stock market drops negative 20, you still collect 10% cash, so your total return is actually negative 10. But that's not even true either, because if I said if the stock market dropped 20%, you would actually, well, my beta is lower than the S&P 500, so the S&P 500 would have to drop 30 or 40%, and your total return would be actually 10, you would take some loss, close, if the S&P, let's say I had half the beta of the S&P 500, if it dropped 40, your account would drop 20, but you still put 10% in your cash. So your total return is negative 10 versus negative 40, but you have 10, you have half, you have money in your pocket. So you can buy the dip or you can live on the 10% cash. And all of a sudden you're like, dude, okay, if you're doing all of that and you have one bad month, and by bad, I mean, 30% less of a drawdown than the benchmark. And on top of that, really, some of this performance is from cash in my pocket. I'm like, yeah, I can't do anything if the stock market collapses. I can lower the beta, which lowers your upside, but I can lower your downside, but I can also pay you. You know what I mean? Like I might have actually lost 3.7, but I paid you 1% cash. And now this is a positive number. So that loss was just sort of a phantom loss, but I still paid you 1% in cash. And the next month I paid you 1% in cash. But here's the other thing. I'm pretty sure my next month was plus 2. So it never really happened, except you collected your cash. You see? So all of a sudden now you're doing comparative analysis of 3 different funds, and the biggest winner could be the biggest loser. And the other determination is the goal. What is your goal? So most retail Forex traders, they don't have a business plan. You're just like, I want to make as much money as possible. That's not a business plan. Every restaurant wants to make as much money as possible. Microsoft wants to make as much money as possible. Every company in the world wants to make as much money as possible, but they have a plan. They have a business plan. They have a strategy. They have key result areas. Those are all tactical plans. And so it doesn't make any sense to wake up every day and like, today I want to make all the money I possibly can. It's just gobbledygook. So you can see, like, if you can construct things, you can organize things. I think building my trade plan, I'm guessing what year that was, 2003, was the most important thing I ever did in my career as a trader. The most important thing I ever did as a Forex trader was write a business plan and a 5-year pro forma cash flow statement. Maybe put it on your to-do list. Okay? So I'll leave it. I have a lot of things to do on your behalf today. I have a lot of meetings. So are you going to play with the idea of trading inside of the wicks? Take the training course at Investor Bootcamp. I think I covered that one in the day trading, because this is just a day trade. This is easy. Okay. Cool. So I hope that was valuable. Okay. Peace on earth. May the pips be with you. May your profits be above average. And I will see you soon. If you're in my swing trading group, it's $99 a month to be in that group. We met on Tuesday, and now we're meeting today. Tuesday was fundamentals. Today is technicals. See how we do that? Oh, that's smart. I know, right? So hopefully I'll see you over at Investor Bootcamp in the afternoon. And remember, what are we doing there? What is the goal? What are we trying to achieve? We are planning next week. Monday, Tuesday, Wednesday, right? And you're like, whoa. You plan next week on Thursdays? Yeah. So by the time people show up on Monday, we're already done. And everybody else are liquidity events. Okay? Who do you think is going to put my children through college? People that don't have a trading plan. Huh? I'm going to run over them like a loaded freight train. Yeah. Peace on earth. May the pips be with you.